Thanks for downloading the Beyond the Numbers podcast. If you hear anything you need clarity on or want more information, visit mycampbellandco.cpa. You can also find more contact information in today's show notes. Thanks for listening. And now, the Beyond the Numbers podcast.
I'm Randy Kardas. Today, I'm tackling a topic that every multi-entity team eventually runs into. That's intercompany. It's the version that makes leadership question the numbers and makes the controller want to live in the woods. I'm going to walk through the real problems today and what happens when you really ignore them and the pattern that we use to clean it up. Near the end, I'm going to jump into Sage Intacct and demo inter-entity journal entry automation so you can see what good truly looks like. So here's the question I like to ask when I'm talking about multi-entity organizations. So if I point at your consolidated income statement and ask, how much is this third-party activity? And how much are your entities actually charging each other? If you can answer quickly and confidently, then things are really good. But if your answer is kinda, that's where it's going to be a little more difficult for you to implement automations. And that's exactly where I love to be, because my favorite answer is kinda. That means we can fix it. And what I don't want is I'm pretty sure, because pretty sure can be expensive when it comes to your accounting. So when intercompany isn't designed well, the cost shows up in three places. First, close time. Every month feels harder than it should. Second, trust. Leadership starts treating finance like a weather app. Helpful, but not reliable. And third, decisions. If internal activity is inflating revenue or distorting margins, people make calls based on noise. I've seen this get brushed off as accounting stuff, but the impact is operational, strategic, and it's real. So let me paint the picture. We've got multiple entities. Maybe it's locations, maybe it's a holding company with operating companies, maybe it's a management company model. One entity pays insurance for everyone. Another entity runs payroll. Someone covers a vendor bill because it was faster. Cash moves around to keep things running. And it's always the same line. We'll clean it up later. Then later comes, then month end comes, and month end becomes a group project where nobody's having fun. Consolidated revenue looks higher than it should at this point. Expenses look strange. The balance sheet accounts, they feel mushy, like you can't tell what's real and what's just internal movement. Then the side spreadsheets start. The controller has one, the CFO has one, somebody on the team has a do not touch file named Final V7. This happens a lot. If that's your reality, your process is not broken. The system is. I want to walk through the problems. The first problem I want to tackle is internal billing inflating results. This is where entity A is charging entity B, and that's fine operationally, but if you consolidate without clean eliminations, your consolidated financial statements now are going to include internal revenue and internal expense. That can make the business look like it grew when it didn't. And nothing makes the CFO or controller more cranky than when this happens. Problem number two. This is having to do with due tos and due froms just not agreeing. I've sat in many meetings where one entity says they owe us this, and then the other entity says, no, we owe you that. And everyone nods like that's normal. It's not normal. It's a design problem. When due to and due froms don't tie by entity pair, the close becomes detective work. And the team spends time proving things instead of improving things. So the third problem is when intercompany gets buried in random accounts. Instead of clear intercompany structure, it lands in miscellaneous receivables, miscellaneous payables, or it gets tucked into expense accounts because it was easier. It is easier that day, but it becomes brutal later. The moment you lose traceability, you guarantee reconciliation pain. The fourth problem is inconsistent coding across entities. One entity uses departments a certain way, another entity uses locations differently. Or the values exist, but they mean different things depending on who posted it. So when leadership asks for profitability by location or service line, the answer is, well, it depends. And if finance says it depends too often, people stop asking finance and start guessing. Problem 5 is cash moving faster than accounting. Transfers happen instantly. The GL reflects reality later. That's simply it. And that happens when your system is not connected to your bank accounts or your credit card accounts. Then you get those awkward moments where leadership or, external constituents ask, why does this entity look broke? And the answer is, it's not broke. The cash moved. We haven't recorded it correctly yet. And again, that's not a people problem. That's a workflow problem. So here's what happens if you don't fix this. Decisions get made on distorted margins. Distributions get based on the wrong entity profitability. And auditors ask more questions because the story isn't clean. Tax prep becomes harder because entity level books matter. And internally, the team burns cycles every month fixing the same mistake. I've watched great accounting teams get blamed for reporting issues that are actually design issues. The goal is not to eliminate intercompany activity from existence. The goal is to keep it clean and visible at the entity level, and then remove it properly at consolidation. Consolidated reporting should reflect the external world. Entity books should reflect operational reality. When those two statements are true, the close gets faster and leadership trust goes up. Here's the pattern we use. It's not complicated, but it does require discipline. First, choose the right method for each intercompany flow. Second, standardize dimensions, so reporting is consistent across entities. That includes GL accounts. Third, enforce a real due to, due from structure. And I'm going to be showing that to you today, how the system can actually do this. Fourth, perform your eliminations consistently at the consolidation level. And then fifth, reconcile by entity pair and use exception reporting so you're not hunting problems manually. Step 1, this is where we separate intercompany into 2 buckets. If it behaves like billable transactions between entities, you're going to want your intercompany AP and AR, right? It's clean, it ages, and it reconciles naturally. If it's a shared cost, that needs to be allocated. Typically, you'll want to use journal entries or allocations, but if the system supports it, it could potentially just do that all for you on your behalf. And you still want structure, drivers, timing, and ownership across those tasks. The key is deciding and documenting the rules so the team posts consistently. And a lot of these systems out there, they actually support that capability where you can assign tasks and ownership within the accounting system. It's not something you can really do with QuickBooks Online. Step 2, if your chart of accounts keeps growing because you need more detail, that's a sign dimensions are really underutilized. I really do prefer a tighter chart with richer dimensions. And that's a really good way to do that is, you look at maybe travel expense, office expenses that have descriptions that indicate departments or locations. Those are great ones that you can eliminate and replace with dimensions. But the important part is consistency. If the same department or location means different things across entities, your consolidated reporting will never feel stable. When we standardize the dimension model, everything gets easier. So step 3, this is where teams either win or lose. Every intercompany transaction should land in a dedicated intercompany structure. No miscellaneous shortcuts. You're going to want to be able to pull a report and see exactly who owes who by entity pair and have it tie without having a meeting with team members. Eliminations should be boring. That's the complement. If your elimination approach changes every month based on who's available or what broke, leadership will never trust consolidated results. We eliminate intercompany revenue and expense, intercompany receivables and payables, and other internal movements where relevant. Then we keep the approach consistent so results are explainable. 5, this is the part most teams skip. And I don't want intercompany reconciliation to be a heroic effort, and it shouldn't be. You want this to be routine. AR equals AP by entity pair. Do froms equal your do to by entity pair. If there's an exception, we see it early and assign it, investigate it, correct it. And really, with the right system and setup, it should be impossible for those to go out of balance. We don't want to wait until someone is trying to hit the finalize close button. If you're thinking your reconciliations are already messy, I get it, because most organizations are. Here's a rollout plan that I have used, and it's actually really realistic. So when you're looking to tie out your reconciliation for, this could be subledgers or intercompany, the first week, you truly want to focus on identifying the top intercompany flows. Not all the flows, but just the top ones. What causes there to be a transaction to the subledger or your intercompany ledger? What causes there to be a due to, due from? Once you've identified all the different ways that those could post, week 2 or the next step is designing the model per flow and locking in the coding structure. Lock in the process so that team members cannot post outside of that. And if you do that, kind of get to week 3 where you're able to implement controls and then train the team to ensure nothing is going out of balance anymore. Week 4 is then establishing a baseline, cleaning up the balances, knowing what it should be versus what it is today. It's going to give you your journal entry to correct everything moving forward as of a certain date. And now you're not dragging on with confusion. And this is going to really help with that, with the last step, which is just truly having true visibility into your intercompany reconciliation. So where do we go from here? This is where I want to showcase what a great intercompany reconciliation and consolidation process looks like leveraging your system. I'm going to prove 3 things. First, we can create an inter-entity journal entry in a structured way, not a free-for-all. This doesn't mean you log into one system, create one half of the entry, then log into the next and create the other half, and then sometimes forget that second half. That can cause it to go out of balance. The second thing I'm going to prove is that due to and due from ties by entity pair. Standard reporting should get you this. You should not have to create custom reports to achieve this. And number 3 I'm going to prove is the consolidated view will reflect the external world after consolidations. If your system is not performing those elimination entries for you, and it's a very cumbersome task for you at month end or year end, quarter close, that's where there's a big opportunity to leverage the system to nail through this. So let's hop into the demo. I want to start. We're going to be using 2 entities. This is the setup. Management Co. and OpCo. The scenario is the management company entity has received an insurance bill for $10,000, and they pay the insurance bill for $10,000. But a portion of it needs to be allocated or charged to OpCo, a second separate operating entity with a separate set of books. Now, this is a perfect example because it's common, it repeats, and it's the kind of thing that gets messy fast if you don't have a process. And looking at that, each entity, if your system allows, this is Sage Intacct's an awesome one for this, each entity should be have a relationship to a corresponding vendor record and customer record. That would help with facilitating intercompany billbacks. So with this, we're going to create a bill, which you can see here. We've got an insurance bill that came from State Farm Insurance. We've got our bill number in. And at the time of data entry, our team actually allocated this out. We had a $10,000 bill. $7,500 is associated with our management co. and 2,500 is associated with our OpCo. So it's 75-25 split. And if we drill into the posting details of this accounts payable bill, here's the impact that it had on our ledger. We can see insurance expense being posted to each entity, and we can also see the corresponding accounts payable balances going up by entity. This is great because now we have an ability to go run a balance sheet and see accounts payable true by entity, which is great. But now this is where we need to understand that once it's paid, we need to see some due to, due from action happening. And so here we can see a payment against this bill, and we'll hop over here. Here's a $10,000 payment coming out of our management co bank account. But if we look at the posting details on this, we actually see at the entity level, accounts payable is relieved the way it should. But then the automation taking place, our inter-entity journals automatically posting. Nothing was needed here. We did not need to tell the system post these offsets. And we can see it's happening naturally, our $2,500 due to, due from. Now, the really cool thing about how your system could be set up is that you instruct it on which GL accounts, due to, due from accounts, you want the system to hit when the automation takes place. And we do that through typically an inter-entity account mapping setup that's going to be in your accounting system. Sage Intacct has a very nice one. Usually you establish this during your initial configuration. Your reseller or service provider helps you do this. And we can see for each entity, depending on whether it's a bill or an invoice that was entered into the system, we can see how the system is going to handle those due to, due froms. And when everything is posted, when it's paid, we have dedicated standard reports built to allow us to visualize the due to, due from our balance sheet. So take note, I mean, this is just so powerful because you might have an Excel spreadsheet that looks something very similar to this. I know I've built many in my time that, either you extract a trial balance into an Excel spreadsheet and you've got formulas that are pulling from your trial balance to then actually get your reconciliation. This is something where you can take your Excel spreadsheet, truly digitize it. And we can see we've got a column for each entity. We can see our $2,500 receivable balance for our management co because they paid the bill. And we can see our $2,500 payable balance for OpCo because they owe that money to the management co. I mean, this is just such a powerful tool. Absolutely love it. And so when these tie automatically, just think the amount of time we spend or waste drilling into those variances because they result from a system that doesn't automatically post the due to, due froms. So why is this really important? It's important because when we go to consolidate our financial statements, and really that's the next step. We've got everything is posted the way we want. This is where I see teams get frustrated because they feel like the consolidation just doesn't look right if it's out of balance. When intercompany is structured, eliminations are consistent, and the consolidated statements remove internal activity automatically, and they show true external performance, not the grossed up revenue and grossed up expense performance that, muddies the waters. That's the whole point. Leadership should be able to look at a consolidated result without needing to have a sideline conversation about what's going on. So we can see here we got many entities in this environment. Think each of these entities replacing a QuickBooks Online company. We've got our OpCo and we got our management co, and scrolling to the right, we have an eliminations column here, which is where we're able to eliminate all of that the internal transfers. So this, I'm going to switch back over to our presentation here, because this is where the last piece is, and it's exceptions. So let's say everything works, but maybe there is something that's wrong for some reason. If something is off, you're going to want to see it early and have an owner assigned to it, and have it resolved quickly before the close is over. And one of the ways you can do that is through checklists. So switching back over, your accounting system might have this embedded within it. Maybe you're managing your close cycle in an Excel spreadsheet. We've got ours in a checklist within Sage Intacct. And when we drill in, we can see all the checklists. And one of them being the intercompany reconciliation. Review the due to, due froms to confirm the balances. They tie out. And who is it? Who owns this? Nick Tesla on the team. So a very nice way to see this. Another really good internal control you should be able to leverage is an ability to restrict which GL accounts should be able to be posted to. So your accounting system may or may not support this, but Sage Intacct does. I'm going to hop in and let's just go look at our due from account for our entity 200. Looking at this, we have a nice configuration option to disallow direct posting. And that's it. No manual journal entries allowed. Only system-generated automation. That is what is going to help build better trust and bring along a faster close. I want to wrap this up. This has been an awesome time being with you. And I'm not saying intercompany has to be perfect. I'm saying that it has to be designed. When it's designed, you get better trust, a faster close, and way less rework. I would absolutely love customizing a Sage Intacct environment based on your specific needs. If you're evaluating software too, it can be a very tough process. We can help guide you through that and help visualize what your data might look like within a system. So I had a blast showcasing intercompany automation today. Join me next time where we go beyond the spreadsheets, beyond the chaos, and of course, beyond the numbers.